The market is not a complex equation. It is a simple mirror reflecting human greed and human fear. You are here because you believe the secret to profit lies in a complicated indicator, a hidden algorithm, or a sophisticated chart pattern. You are wrong. The secret is arithmetic so basic you learned it in grade school, yet you continuously choose to ignore it. The market punishes you not for misunderstanding Fibonacci, but for failing the fundamental test of risk control. Every devastating loss you have ever taken was not a consequence of poor stock picking, but a failure of position sizing. You focus on the entry, an act of fleeting excitement and hope. The professional focuses only on the exit and, more crucially, the volume of capital at risk. This is the difference between a speculator and a gambler. The speculator defines the maximum acceptable loss before defining the potential gain. Your fancy math, the volume-weighted averages, the stochastic crossovers, the complex multivariable models, they are all noise. They are distractions designed to keep you from confronting the single brutal reality of survival. That reality is the absolute, uncompromising control over your exposure. The true signal you must learn to read is the one that prevents your emotional system from overriding your logic. That signal is the size of the trade. If the position is too large, the smallest price movement triggers panic, fear takes over, and your rational plan collapses instantly. You must neutralize the fear response. You must immunize yourself against the volatility that wipes out the unprepared. You do this by controlling the mental volume. The theme of this conversation is survival. It is about understanding that long-term speculation is not a pursuit of grand, immediate riches, but a marathon of capital preservation. The first rule, the only rule, is simple. Do not lose your money. The only way to enforce this rule is through rigid position sizing. Every trader who has ever stood where I stand, who has survived the inevitable cycle of boom and bust, knows this truth. We are not geniuses. We are simply disciples of the fundamental law of controlled exposure. The market does not care how smart you are. It cares only about your discipline in managing risk. The man who allocates 50% of his capital to a single trade has already failed. He has handed control of his mind and his fortune to the market's randomness. He is awaiting execution. He is trading from a position of desperation, which is the fastest route to financial ruin. We are not chasing short-term price fluctuations. We are engineering long-term survival. This requires a mathematical framework that ensures you can withstand the inevitable, crushing volatility that defines speculation. You must ensure you can fight another day. The novice sees opportunity, the master sees risk. The novice asks, "How much can I make?" The master demands, "How much can I lose and how can I limit that amount absolutely?" This fundamental shift in perspective is the entire game. We must define the absolute quantitative relationship between the capital we allocate and the movement in price we can tolerate. This is the core of speculation. This is the core of survival. The market is a system of perpetual chaos, punctuated by brief moments of trend. You must be positioned to profit from the trend, but you must be sized to survive the chaos. The crowd is constantly trying to guess the next move. The professional is calculating the appropriate volume for the next inevitable disaster. Your ultimate goal is to maintain a maximum acceptable drawdown. This is the only functional arithmetic required to ensure long-term survival. Obsessing over short-term price movements is a fool's errand. Obsessing over your capital preservation is the work of a professional. Let us define the arithmetic that matters. It is a three-step process, nothing more, nothing less. Ignore it and you will be crushed. Step 1. Define your maximum risk per trade. This is not a vague feeling of discomfort. It is a hard numerical percentage of your total trading capital. For the disciplined professional, this number is small. It must be small. You cannot risk more than 1 or 2% of your capital on any single speculation. If you risk 5%, you are arrogant. If you risk 10%, you are reckless. If you risk 20%, you are already bankrupt. You just haven't received the margin call yet. Consider the consequences of a drawdown. If you lose 10% of your capital, you need an 11.1% gain to get back to even. That sounds manageable. If you lose 50%, you require a 100% gain to restore your original capital. That is a devastating hole. The arithmetic of recovery is not linear. It is exponential. Every dollar lost requires a disproportionately larger dollar gain just to break even. This is the critical, fundamental arithmetic the crowd ignores in their desperate chase for oversized wins. They fail to understand that the first step to massive profit is the preservation of capital. Position sizing is the mechanism of capital preservation. It is the firewall against the arithmetic of ruin. You must standardize your risk exposure. This is the absolute law of the market. You must risk the same dollar amount on every single trade, regardless of the security's volatility or price. Step 2. Determine your stop-loss point. Before you execute the trade, you must know precisely where you are wrong. This is the technical reality of the speculation. It is the price point that invalidates your entire thesis. It is not an arbitrary number. It is a structural point on the chart where the market has proven you incorrect. This is the distance from your entry price to your stop-loss price. This distance is measured in points, or dollars, or cents. This distance is what the market is demanding you pay for your hypothesis. This is the price of speculation. The market demands that you know your exit before you know your entry. The crowd operates in reverse, entering on hope and exiting on panic. The professional defines his maximum exposure and then lets the market tell him the appropriate stop-loss point, which leads us to the final calculation. Step 3. Calculate the number of units to trade. This is where the magic of discipline happens. This is the only equation that determines your success or failure. The calculation is simple. Position size equals total capital times risk percentage divided by entry price minus stop price. You are solving for the volume that keeps your dollar risk consistent. You are not letting the price of the stock determine the size of your trade. You are letting your risk tolerance determine the size. The crowd operates in reverse, buying a round number of shares that makes their potential loss unmanageable. If the stock is highly volatile and requires a wide stop loss, your calculated position size will be small. This is the market protecting you from yourself. If the stock is less volatile and allows for a tighter stop, your calculated position size will be larger. In both cases, the dollar amount you stand to lose remains exactly the same. This is mechanical consistency. This is risk standardization. This is what allows you to survive 5, 10, or even 20 consecutive losing trades without compromising your entire account. The professional knows he is just as likely to lose the next trade as he is to win it. Therefore, he sizes his position to ensure that a string of losses does not take him out of the game. The emotional trader takes a small loss, then tries to recover it instantly with an oversized trade. This is a common form of financial suicide. The market does not reward desperation. It feeds on it. You must understand the destructive nature of emotional recovery attempts. Oversizing is the symptom of a mind broken by minor loss. You must look at your equity curve as an objective force. The maximum drawdown is the only number that truly matters. If your system requires you to withstand a 20% drawdown, you must size your position such that a catastrophic string of losses does not exceed that threshold. The correct position size is the shield that ensures this. Think of it as a battle campaign. You do not send your entire army into the first skirmish. You allocate forces systematically, ensuring that a major defeat does not mean the total loss of the war. Your trading capital is your army. Preserve the capital and you preserve your ability to fight. The crowd sees the price moving and gets excited. They chase the move, doubling their typical position size because they feel certain this time is different. This is the precise moment the market is setting the trap. Oversizing based on conviction is the ultimate act of amateur arrogance. True conviction is expressed not by the size of the trade, but by the meticulous adherence to your established risk parameters. If you believe the move will be massive, you do not need a massive position. You need patience. Let the trend work for you. Let the market prove you right. The problem with oversized positions is the psychological toll. When you have too much capital at risk, every small price retracement registers as a catastrophic failure. Your lizard brain takes over. You cut winners short out of fear that a profit will disappear. You hold on to losers too long out of a desperate hope that the market will save you. The correct position size allows you to withstand the natural volatility. It grants you the patience to allow a trade to develop. It allows you to hold through the inevitable shakeouts that define a major trend. It is the antidote to fear and the foundation of discipline. I remember a time early in my career when I had built a substantial cushion. I felt invincible. I found a situation I believed was a guaranteed winner, a classic, powerful accumulation pattern culminating in a decisive breakout. I abandoned my discipline. I allocated 25% of my capital to this single speculation. The initial move was explosive, confirming my conviction. I felt like a genius. But the market has no respect for arrogance. The breakout failed, and the stock crashed back into its prior base. My disciplined stop, which should have been minor, suddenly represented a massive hit to my entire account. I refused to take the loss. The position was too large. The pain of realizing that loss was too great. I moved the stop. I rationalized the volatility as a shakeout of weak hands. I was no longer trading. I was hoping. The stock continued to drop. By the time I finally capitulated, I had watched more than a third of my entire trading capital evaporate. It was a failure of the mind, enabled by a failure of arithmetic. The loss wasn't a punishment for being wrong about the stock. The loss was a punishment for being wrong about my own mental capacity to handle the risk. The lesson was brutal and unforgettable. The price action did not control me. The position size controlled me. My oversizing turned a statistically acceptable loss into a psychologically devastating disaster. It took me months of meticulous small-sized trading to recover that capital, not through a single spectacular win, but through mechanical consistency. This story is not unique. It is the common story of every trader who has failed. They believe their conviction trumps the math. They believe they can control the outcome. But the only thing you control is your own actions. Your action must be the mechanical, standardized control of position size. The single most functional arithmetic you require is the calculation that ensures you can always, without fail, take the next trade. If your maximum loss is consistently 1%, you can endure 50 consecutive losses before you're halfway to ruin. 50 losses in a row is statistically improbable, but surviving 50 losses is the definition of a robust professional system. If you risk 5%, 10 consecutive losses put you in that arithmetic of ruin, requiring a disproportionate recovery. You are operating too close to the edge. You are guaranteeing your own panic. You are handing the market a loaded weapon aimed at your own head. Position sizing is your way of telling the market, I am willing to rent this opportunity for a statistically defined amount and no more. It is a transaction with a predetermined expiration. You are buying time to be right, and the price of that time is the defined risk. The crowd does not buy time. They buy lottery tickets. They bet big and hope for the instant win. They fail to understand that speculation is the compounding of small, controlled risks over a vast number of statistically independent events. The 1% rule is a law of large numbers. You are playing an expected value game. You will have losing trades. You will have winning trades. The only way to realize your system's long-term statistical edge is to ensure that no single loss can interrupt the sequence. Position size is the regulator that prevents any single event from becoming an extinction-level event. When the market is trending powerfully, the temptation to increase your size is immense. The chart looks perfect. The volume confirms the move. You feel the momentum building. This is the danger. This is where the experienced trader maintains his standardized risk. You do not need to size up your trade to capture a large trend. A massive trend will deliver enormous profits even on a small, controlled position. The risk of oversizing during a seemingly perfect trend is that the inevitable, sharp, violent correction will wipe out weeks of profitable work in a single session. Preserve the capital. Let the profits run. Do not conflate conviction with increased leverage. Leverage is a tool for fools who do not understand the arithmetic of drawdowns. Professional speculation is about optimal exposure, not maximum leverage. The primary competitive edge in the market is psychological, and it is directly funded by correct position sizing. When your position is correctly sized, you become detached. The price movement is no longer a personal affront. It is objective information. A 20-point drop in a correctly sized position is a statistical event. A 20-point drop in an oversized position is a heart attack. The professional acts on information. The amateur reacts to emotion. The correct size is the catalyst for logical action. When you size correctly, you have the patience to allow the trade to come to its conclusion. You do not fidget. You do not worry about the daily noise. You have defined your maximum loss, and you know that the trade, even if it fails, cannot destroy your ability to continue. This patience is the difference between capturing a 10-point move and capturing a 100-point move. The true master is an observer. He observes the trend and he observes his own reactions. He knows that when the size is right, the reactions are subdued, logical, and disciplined. When the size is wrong, the reactions are amplified, chaotic, and ruinous. Your trading plan is not complete until the position size is calculated and locked in. The entry is an afterthought to the risk. The exit is predetermined. The volume is standardized. This entire mechanical structure removes subjective psychological input, which is the ultimate contamination of any trading system. The amateur believes that the market dictates the size. The professional understands that his risk profile dictates the size, and the market only supplies the price points for the calculation. This inversion of priority is the key to surviving long enough to harvest consistent returns. Look at the structure of the market. It is designed to extract capital from the impatient and the overexposed. It uses volatility and sharp reversals as tools to induce panic selling and buying from those who have risked too much. Your correct position sizing is the countermeasure. You must operate with a detached consistency. The wins should not excite you. They are merely the statistical realization of your edge. The losses should not depress you. They are merely the cost of doing business. The only thing that should concern you is a deviation from your standardized risk. A small position allows you to think clearly. A small position allows you to move your stop to protect profit as the trend unfolds. A small position allows you to add to a winning position on a confirmed pullback, scaling in without compromising your total risk for the entire campaign. Oversizing prevents all strategic flexibility. The moment you find yourself hoping for a rally or praying that a stock will hold a certain level, you are already violating the core principle. Hope is not a strategy. It is a spiritual contaminant in the rational world of speculation. The oversized position is the incubator of hope. You must standardize your risk across all market conditions. A fast-moving, high-momentum stock requires a very small number of shares to keep your 1% risk intact due to the wider stop required to weather the volatility. A slow, grinding base-building stock allows for a higher share count. The dollar risk remains the same. This is the non-negotiable law of the mechanical speculator. The market will offer you infinite opportunities. Your capital is finite. Your job is to make your capital last long enough for the profitable opportunities to materialize and run their full course. Position sizing is the conservation of force. The primary battlefield is your inner world. The market is just the arena. The size of your bet determines the noise level in your mind. Keep the bet small, and the mind is quiet. When the mind is quiet, the logic of the system can operate. This mechanical consistency harvests profits regardless of transient price fluctuations. The goal is not to be right on one trade. The goal is to be profitable over 100 trades. The position sizing ensures you survive the 99 that don't pay off immediately, so you can be present for the one that makes your month or your year. Your ultimate competitive edge is achieved when the predetermined, standardized volume removes subjective psychological input. You are not trading emotions. You are executing a mathematical plan. The plan requires the consistency of a machine. The size of the position is the governor on your ego. When the position is small, you cannot afford the luxury of arrogance. You are forced to wait for confirmation. When the position is large, your ego tells you that you are smarter than the market, a delusion the market will quickly cure with financial devastation. The only math you need to survive is the math of capital preservation. You must ensure the consistency of your risk. You must standardize your position size based on dollar risk, not arbitrary share count. This is the reality. This is the bedrock of professional speculation. Everything else is secondary noise. The market has only one question for you. Are you a professional or are you a tourist? The professional manages his maximum drawdown meticulously. The tourist gambles on maximum upside. Their arithmetic is the difference between survival and ruin. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I'm talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.